Assalamualaikum and a pleasant day to each and everyone. My name is Kasan Analin and we are the Group 4. We will report about the Chapter 13 Accounting Periods, Methods, and Other Compliance Requirements. An accounting period is the time that a set of financial statements cover. The period business transactions are added to a system to create financial statements and reports. The taxable year means the calendar year or the fiscal ending during such calendar year, upon the basis of which the net income is computed. There is two periods of accounting. First is the calendar year, means accounting period of 12 months ending on the last day of December. This period is only option that an individual taxpayer may have. Second is the fiscal year, means an accounting period of 12 months ending on the last day of any month other than December. So this period is not allowed to individual taxpayers to use, only the partnerships and corporations. So there are cases that income can be computed on the basis of calendar year. First is if the taxpayer does not keep books of accounts, so the calendar year must be used. Second, if the taxpayer has no annual accounting period, so if does not know what accounting period is, then the calendar year shall be used. Third, if the taxpayer is an individual. Again, an individual taxpayer can only use the calendar year. And fourth, if the taxpayer's annual accounting period is other than a fiscal year. So if it's not a fiscal year, then it must be a calendar year. So accounting period may be less than 12 months, or what we call the short accounting periods. This may arise when a corporation is newly organized, when a corporation is dissolved, when a taxpayer dies, and when a corporation changes accounting periods. So if a taxpayer other than an individual with the approval of the Commissioner on Internal Revenue changes the basis of computing net income from fiscal year to calendar year, from calendar year to fiscal, or from one fiscal year to another, the net income shall, with the approval of the Commissioner, be computed on the basis of such new accounting period. So from calendar year to fiscal year, final or adjustment returns shall be made for the period between the close of the last calendar year for which the return was made and the date designated as the close of the fiscal year. So here, an illustration to understand the calendar year to fiscal year. ABC Company is currently using a calendar period in computing its taxable income. On May 16, 2018, it is decided to change its taxable period from calendar to fiscal year, beginning June 1, 2018 and ending 12 months thereafter. So how should this change be treated? So from January 1 to December 2018, that is our old calendar year. So it is ABC Company decided to change it from fiscal year. So from June 1 to May 31, 2019, that is our new fiscal year. So from the decision to change is made on May 16, 2018. So from January to June, that is our what we call adjustment return. So why it is called adjustment return or adjustment period? Because there be an income or expenses which cannot be included in our income starting June 1 to May 31, 2019 because it is a new fiscal year or a new 12-month period. Therefore, the ABC Company has to file adjustment return covering income and expenses from June 1 to May 31, 2019. So our normal return is from June 1 to May 31, 2019. Second is from fiscal to another fiscal year. Final or adjustment return should be made for the period between the close of the former fiscal year and the date designated as the close of the new fiscal year. So from our same previous example, on June 20, 2018, CatCat Company decided to change its fiscal year to another fiscal. Currently, its fiscal year begins on May 1 and ends on April 30. It is decided to begin a new fiscal year starting July and 12 months thereafter. So how should be this treated? Same with the calendar year. The process is just the same, is that fiscal year is to change to another fiscal year.